Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Cloudflare stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 51 billion market cap. They're trading at 167 a share, and they have 305 million shares outstanding. They help make websites faster and more secure. Their product is used by more than 26 million sites, and it processes over 1 billion IP addresses each day. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Negative in 21 and 22, their first positive in 2023. It is up 42% in the trailing 12 months, 170 million. They converted 11% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That is negative, but it does improve each time period from negative 260 million to negative 94 million. Revenue is the sales for the company, and that more than doubled from 650 million to 1.6 billion. They grow every single year. The growth has subsided. It grew 49% in 2022, 33% in 2023, 21% into the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 32 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $27 billion. We divide that by 300 million shares. And we get a calculated stock price of $89. They're trading at 167, so they're trading at an 88% premium. It's a really big sell according to the model. There are 150 companies in the same industry as Cloudflare, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend pretty close to the median in CapEx, 169 million. These are the investments in property, plant, and equipment. Their debt to equity ratio is equal to the average at 1.5. That means for every dollar of equity, they have $1.50 of debt. They do not pay a dividend. Oracle pays the highest 0.9%. Microsoft also pays a dividend. Only those two companies pay a dividend out of the top 20. Not much free cash flow, 170 million. Microsoft is number one by far. Microsoft is the top 3 companies in the world. They rank 9th in market cap, a good amount behind Fortinet and Synopsys. Their price to book is 53. That's stock price over book value per share. That means they're trading at 53 times book value. Book value is on the balance sheet. It's assets minus liabilities. It's the value of the company according to the balance sheet. They have negative earnings, so we can't look at their PE. One of the worst price to free cash flow is on this list, 300. Corpay is number 1 at 12. They're trading at 32 times revenue. They don't generate that much revenue, 1.6 billion. A good amount lower than Zscaler, a lot lower than GoDaddy. But their 5-year annual revenue growth rate is real high at 43%. CrowdStrike is higher at 56%. The stock keeps going up, so it's trading at its 52-week high, 114% above its 52-week low. If you put $10,000 into this company when they started trading, after 2 years in 2021, you would have been at $105,000. Then it would have came way down, but now it's coming back up. Your $10,000 will be $89,000, a 50% annual return. To summarize, I have them trading at an 88% premium, ranking 6 out of 10. It's a good company, but it's a little high, the stock price, because it keeps going up. It keeps breaking its 52-week high. So I probably wouldn't buy it short term, 3 out of 10. But I would buy it and hold it long term because I think it will go up over time. There's going to be a pullback, but I don't know if it's going to be now or in a few months from now or a few years from now. No one knows. Really poor ratios, 2 out of 10. According to their price multiples, they seem really, really overvalued. Financial, 7 out of 10. Revenue looks great. It goes up each year. Free cash flow looks good as well. It was negative, now it's positive. Let's take a look at their income statement. Here's the third quarter of 23, third quarter of 24. Revenue went up nicely, about 33%, 330 million to 430 million. Let's see if they give a breakdown of the revenue. Half the revenue is in the US, 215 million, exactly 50%. Last year for the third quarter is 52%. So revenue is growing more in other countries. EMEA is flat. It's still 28%, 122 million. Of course, it's up on a nominal basis. It was 93 million last year. APAC went from 13% to 14% of the revenue. Now it's 59 million. All other countries, 34 million. Here's a different breakdown of the revenue. 89 million channel partners. That's 21% of their revenue. Last year it was 16%. Direct customers. That's much higher margin than channel partners, 340 million. That was 84% of their revenue. Now it's 79%. Here's a little more info on the revenue. It went up 28%. It went up 94 million, 335 million to 430 million. And they talk about the increase. It was due to the addition of new paying customers. Their paying customers increased 22% from last year. Also, expansion within our existing paying customers. So their current customers are spending more money, which was reflected by our dollar-based net retention rate of 110%. Below revenue is cost of revenue. These are all the expenses directly related to generating the revenue. 96 million. It was 78 million. Let's look on a percentage basis. It's on this page. This year, cost of revenue is 22% of their revenue. Last year it was 23%. So margins went up from 77% to 78%. They converted 78% of their revenue into gross profit. They give more color on cost of revenue. Since cost of revenue went up 18 million, the increase was due to 6.6 million in expenses related to operating in co-location facilities. That means they share the location with another company, and network and bandwidth costs for operating a global network for their expanded customer base. Also increased capacity to support their growth, an increase of 4.5 million from third-party technology services, an increase of 2.9 million in payroll. That was offset by a $1.8 million decrease in depreciation, so depreciation went down 1.8 million. The depreciation expense was driven by a 3.5 million decrease from the impact of the change in useful life of servers associated with cost of revenue. The useful life went from 4 years to 5 years, so they're spreading the expense over 5 years instead of 4. Partially offset by an increase related to the purchase of equipment located in co-location facilities. Co-location, or some people say co-location without the dash, that's when a company places their own servers and other computing hardware in a space rented in a physical data center owned by a third party. They're putting their hardware in a data center owned by someone else, which means they don't own it, they just rent it. Let's look at their operating expenses. Sales and marketing, 185 million. R&D, 111 million. G&A, 69 million. So operating expenses went up quite a bit, from 300 million to 360 million. Let's look on a percentage basis. Sales and marketing went down from 45% to 43%. R&D went down 27 to 26. G&A went down 17 to 16. So all their expenses went down. Their operating expenses as a percent of revenue went from 89% to 85%. They still had an operating loss in both time periods, but the loss is smaller. It was 12% of their revenue, now it's 7%. On a dollar basis, it's still smaller, 39 million to 31 million. So sales and marketing went up 35 million. The increase was driven by $20 million in payroll. That's because of an 11% increase in headcount. There was also an increase of 4.3 million in stock-based compensation. The remainder of the increase was due to an increase of 6.5 million in expenses for marketing programs from acquisitions, investments in brand awareness advertising, third-party industry events, and digital performance marketing. Also an increase of 3 million in co-location and bandwidth expenses for free customers. In R&D, the increase was driven by a $21 million increase in employee-related expenses due to a 29% increase in headcount. Also a $5.7 million increase in stock-based compensation. That's when you pay your employees with stock. G&A, the increase was driven by 11 million in employee-related costs due to a 19% increase in headcount. Also an increase of 5.2 million in SBC. So the increases were pretty consistent across the board. It's just more employees. So they're paying more in payroll and stock-based compensation. They show you the actual stock-based compensation. Cost of revenue had 2.8 million of stock-based compensation. So total cost of revenue, 96 million. Of the 96 million, $2.8 million of stock-based compensation. For sales and marketing, $185 million. Of the $185 million of sales and marketing, $24 million is SBC, R&D SBC $39 million, G&A SBC $23 million. They had $23 million of interest income. Last year was $18 million. So interest income went up $4.5 million or 25%. The increase was due to an increase in interest rates and the amount of money they invested. Interest expense is $1.4 million. Last year it was $1.1 million. That's the interest they pay in their debt. They don't give any information on that. So their pre-tax loss is $13 million, $2.5 million of taxes, net loss of $15 million. Last year they had a net loss of $24 million. Let's look at a company on Simply Wall Street. Its last price, $167, 58 billion market cap, up a lot, up 20% in the past week, up 54% in the past year. They IPO'd in the third quarter of 2019 at $21. The peak was in 2021, $207. Over the next 6 or 8 months, it came down about 80%. It fell to the low 40s. And it pretty much traded sideways for a couple of years. So you could have got it as low as 68 in mid-2024. And it's just shot up like a rocket ship the past couple of months. Just last month, it was 110. Now it's 167. But Simply Wall Street thinks the stock is really overvalued. Their valuation is 76. 30 analysts priced this stock at 141. They also say it's overvalued. Here's their revenue since 2016. It was only $85 million. The revenue 10x'd from $85 million to almost $900 million in only 6 years. A lot of that was through acquisitions. So it was $900 million in September 2022, and it nearly doubled. It's currently $1.7 billion. This is for the trailing 12 months. Just the other day, they released their annual earnings for all of 2024. But that's not why the stock went up so much. It's from DeepSeek. Here's an article from February 7th. The shares are up on Friday because they beat their forecast. The stock jumped 14% to 161, while Fortinet, another cybersecurity company, was down 0.3%. But the CEO's comments on 2 of the biggest stock market stories is more interesting to investors. Their CEO weighed in on DeepSeek on a post-earnings call with analysts. The rapid rise of the Chinese startup's new AI model, seemingly made on the cheap, sparked by a brutal sell-off last week, fueling fears that AI spending could crater. This idea that the only way to win in AI is to spend hundreds of billions of dollars or even trillions of dollars. I think DeepSeek shook that foundation because DeepSeek proved you don't have to spend that much money. You can build these things for a few $1 million. His comments echo Microsoft CEO. He said a 19th century economic concept known as the Jevons paradox to argue that cheaper AI would boost demand over the longer term. Let's go back to Simply Wall Street. Look at their debt. They were debt-free in 2017, 18, 19, and 20. They added some debt in 2020. The peak was $1.4 billion in 2022. It is down to $1.3 billion. Equity is lower than debt. Equity of $1 billion. Debt of $1.3 billion. Let's see how much cash they have. They have more cash than debt, so it's like they're debt-free. The CEO's salary is flat at $400,000. Total compensation, $20 million. Tenure as CEO, 15 years. In the past year, there's been insider selling, no buying. And 77% of the company is owned by institutions, 12% by the general public, and 11% by insiders. The biggest shareholder is Capital Research at 10%, then Bailey Gifford. BlackRock at 5%. You have Polar Capital at 1%. And then to round out the list, SquarePoint at 0.4%. Their employee count has gone up a lot from 865 to 4,200. And their ticker trades on the New York Stock Exchange, Deutsche Börse, Börse Stuttgart, Mexican Bolsa, London Stock Exchange, and Sao Paulo Bolsa. So if you want a copy of a discounted cash flow model, click on the video in the top right corner.